And what my hope would be is to give you a few tips on possible arrangements to maximize the amount that comes to you in your retirement days, because obviously the more income that you have during retirement, the more fun you're going to have when you're done with your working days. So getting started, we're going to go through a lot of comments about, what is the situation today? And the reason we put this on is people are kind of hurting their retirement a bit by making what are not the very best decisions when it comes to Social Security. There are actually somewhere close to 15,000 combinations of age and opportunity and choices that someone could make. But with that many, we're going to focus on about 5 most common situations that we run into and how we try and help people improve on what they're doing in making those choices. Can I see a show of hands? How many folks in the room are already 65? All right, so we've got a few. How many over age 60? We won't ask for birthdays, but all right, so that's good. So you're looking at your planning because the first point in time when you can utilize Social Security is age 62. How many folks have already gone online and set up your My Account at Social Security? All right, that's great. You want to be doing that as soon as you can, folks, because to get something personalized, we need to know what your numbers look like, and that's how you access it, is by setting up your account. Once again, my appreciation to TechCell. Because of their sponsorship, we're able to help you with something like the customized analysis so that you have a better feel for how Social Security could best work for you. So what do we need to know about Social Security? Well, we already talked about there are thousands of claiming options, but their decision that you make when you decide to start Social Security, you can make that decision. The law has changed in the last few years so that you have 12 months to change your mind. So you can undo a decision that you make, or you can change it in the first 12 months from when you start your Social Security. After 12 months, that decision is frozen for the rest of your life. So you want to make sure, I would suggest that you be doing enough planning so you know how you want to, in fact, collect your Social Security and start your first check before you ever start it. But you should know that if for some reason you have some discussions and somebody convinces you there is a better path, you can, in the first 12 months, now this isn't easy, but pay back Social Security whatever you've received in checks for those number of months you've been there, up to the first 12. The first anniversary, you've made your decision. But if you want to change your mind in the first 11, let's say 11 and a half months, as long as you can write them a check to give it back, you can then change and start over and pursue possibly a decision that would pay you more for the rest of your life. The choices that you make for Social Security are really impactful on your spouses. What you decide to do from your account has a huge impact on your spouse, because when you die, your spouse is entitled to the monies from your work record. Now, if the spouse was the higher earner, then you're going to move up to their earnings record. If you're the higher earner, well, then that's great. You're going to be benefiting from your earnings account for the whole time that you're receiving Social Security, and then your spouse will also benefit and move up to your record if it's the larger one when you're gone. So the system isn't bankrupt. It is a pay-as-you-go system. It was designed that way. So the good news is we used to have 5 or 6 workers for every retiree, obviously in the early years, started in the 30s. And by the 50s, we still had a huge workforce providing the taxes going in, and in the same year paying out the fewer beneficiaries their checks. We're down to now a little slightly less than 2 workers paying in for every beneficiary who is getting funds back out. So the problem we have is that pile of, say, boomers doing all of the input with their peak earning years going in, it's also rapidly coming out, and more retirees from COVID, or anytime I worry that we have a recession, there are going to be fewer jobs. Few people decide, well, geez, they're downsizing, maybe it's time to go ahead and retire. Hopefully that's something you planned on as opposed to a surprise. Benefits do help family members. It's not just you and your spouse, but it's even in family members as well. And while you do have friends that know about Social Security, my only suggestion is their situation may be far different than yours. So the things to know about Social Security is you really want to deal with somebody in the know. The Social Security Administration has a lot of very good employees. So baby boomers are usually asking, what I'm hearing is, well, is it going to be there? How much can I expect? It's easy for you to get an estimate. When I should apply to Social Security is a question we'll try and help you with today, as well as how can I maximize those benefits, and will Social Security be enough to live on in retirement? One of the things that we talk about is Social Security. When it was first put together, it was supposed to be one part of a three-legged stool. We were going to have the government with Social Security. We've been paying in for our work time, and the government will provide us with a check. The second part was, in the old days, more than 60% of the population were covered by pension plans, which said for every year you work, you earn some credits, and then that will provide from that a monthly benefit for the rest of your life as well, unless you want a lump sum, and sometime that's paid out. That's mostly been changed to the defined contribution plans, your 401ks. So you're putting money in, it's being invested, and then when you leave, you've got a retirement pot that is taxable when it comes out because it's deferred tax investments, but that would be the second leg of the stool. And the third leg of the stool is you are expected to provide at least a third of your retirement from your own personal savings and investments, whether it was rental house income or municipal bonds or savings bonds or good stocks that you've picked with the help of a broker in the stock market. But those were three legs of the stool. The bad news is, in the United States, we have at least a third of our population who count only on Social Security. Now, Social Security is a very valuable source of income in retirement, but we all need to be doing planning because you won't necessarily have a comfortable and happy retirement if you're only relying on Social Security. Currently, the statistics say that in our retired population, about 40%, on average, about 40% of a retired person's income comes from Social Security. So that means already most people are making up the rest of their retirement income, 60% of it, from either pension plans or personal savings and investment. So there's a question now, will it be there for me? Well, what we're looking at, as I mentioned before, this is the trust fund. We have a commission appointed by your politicians in DC. They look after the trust fund, and they have a report every year. What you can see is there's still a couple of $1 trillion in it, but they're paying out $56 billion more between 20 and 21 than they took in from the current workforce. So at any rate, what we're looking at is we've got almost $3 trillion left as of last year. Obviously, that'll go down. I wouldn't hazard a guess whether it's another 56 billion or another 75 billion. But what that leads to is a question of, well, what's going to happen in the long term? Because we did make changes to Social Security in 1983. Both raised the amount that all of us were paying into out of our salaries, and then in the meantime, there's been a level of cutoff where Social Security is taken out of your paycheck until you paid, it used to be $98,000, went up to $107,000. This year, you'll be taxed for Social Security and Medicare up to $147,000. But after that, there's no taxation on higher earners. Now, you might say, well, how did they get away with that? Well, as we'll show you, when you calculate, there's very, very little credits or income that comes to higher earners for anything over that maximum amount where they're being taxed. So it's not really, shall we say, unfair. One of the things they're looking at doing is saying, well, we'll have a means test. So quite honestly, we can do things like say, well, we'll tax somebody more based on what they're earning during their lifetime. But as it is right now, you do have that, the taxation out of your paycheck. The premium you pay goes up to $147,000 in 22, and that'll probably be adjusted up a little higher with inflation these days next year. But so there, you're looking at the situation where it's kind of like, gosh, do we want to have all of our payees suffer a 20% drop in 2035? That's what the math guys have said. Well, if we keep on this path that we're on, we'll have to make an adjustment. So if you were, for every $1,000 you were receiving, all of a sudden that would be $800. Well, usually we're expecting inflation to be going up, so that would make it a lot tougher for everybody to live on what they got. So one of the other things you talk to your congressman about is what are you planning to do to reform things? Because we've got about a dozen years to get it in place. Actually, we've probably got 2 or 3 years. We ought to get it in place so that we have another decade for it to catch up and change that dynamic. Otherwise, there will have to be a reduction in benefits. For boomers, for folks that are already on Social Security, it's likely that they would see a lesser amount than that. It's usually grandfathered so that the oldsters don't burn down the Social Security offices. But the point is, they usually set things for a change. Like in 1983, it really grandfathered folks. They weren't changed as much as the folks that had not reached Social Security age in the 80s. So it has less of an impact, and we're getting pretty close to having the last of the baby boomers through. So I don't think it'll have as big an impact, but as you can see, in 2035, they're talking about benefits percentages would go down to 80% of what was projected, and then they take it all the way out. This is modeling. It's kind of like the weather. Sometimes they get it right, sometimes they're not so right, but they estimate that they'd have to make another cut in 2096 of down to 74% of what would be today's projection. So if that's the case, what they're saying is if we drop it down in 2035 by 20%, that would be a change that would work through the system for quite a few years. All right, so that's what we're facing. I want to point that out because there is a question about, well, I'm going to take my money right now because it's not going to be there. Well, we know there's $3 trillion almost there right now, so the money is there, and for most of the baby boomers, it's probably pretty well protected. So right now, how do we restore that? What's the best system to avoid any kind of reduction? It would be going above 147,000 as far as subject to the tax. They're still talking about raising the normal retirement age. It, of course, was done in 1983. It changed to 67. And everybody in 1960 and later, it's now your normal retirement age without any reduction is age 67. If they moved it out to a normal age of 70, those extra 3 years would have an impact of not worrying so much about the depletion of the account. The other point is, obviously, they could lower benefits for future retirees and change the way that they calculate it so that it's based on consumer prices maybe instead of wages, because right now they look at what is the average wage in the US and of the people paying in. The other thing would be to say, well, instead of just taking the cost of living adjustment, the COLAs, which everyone gets a COLA every year once they're on Social Security and already receiving their monthly check. And they could reduce those to half COLA or to a flat percentage. So the bottom line for baby boomers, for those of us who were born in 1960 or before, your benefits are not that likely to be impacted unless the system really has larger problems than we've seen in the next few years. So that's the good news. For folks that are born after 1960, you're kind of in the middle there. We really would encourage you to work with your congressional folks to say, let's solve this problem before it gets worse and has an impact on how much my Social Security will pay me in the future. So another way to look at Social Security is, and these are insights that I hope you can take away, and as I say, it's in your package to review at home, but Social Security is a very valuable inflation-protected income where you're getting paid back for having paid those dollars through your paycheck for roughly 35 to 40 years of a work life. that's pretty valuable. You cannot outlive this income. And if you take a look at, once again, using a very conservative 2% cost of living adjustments, as you can see, if you were only making a benefit of $2,000 today, now I say only, and I'm aware that the average benefit is a little less for folks starting to draw Social Security, on average is less than $1,700 these days. But using $2,000 in 10 years, you'll have seen over $250,000 come into your bank account. 20 years later, you'll have over $500,000 by quite a bit come into your account. And obviously, the healthier you are, the longer you live. If you're retiring at 67 and living to 97, you'll see $1 million come back out of a $2,000 primary insurance amount. If you have a lesser amount, you'll see less. But quite honestly, if you have an estimated amount above $2,000 a day, you'll see larger numbers than this. This is a very valuable benefit for your lifetime. So the other thing is you do get adjustments for inflation. So that $2,000 in 10 years, the benefit check is going to look appreciably better at $2,400 plus. And in 20 years, it's going to go up by almost, 50% to almost $3,000. But with the adjustments for cost of living allowances, you have an inflation adjustment that allows you to hopefully keep up with the cost of living in the future. How much are you going to receive? Well, it depends on a couple of things. Your benefit is going to depend on what your work record is and how much you've earned. Benefit will also depend on what age you decide to apply for the benefits and turn them on, to start them. So we calculate benefits by looking at wait until you're age 62, and then what they'll do is they'll tally all of your past earnings up. They will use the highest 35 years that you have been paying in. So that's the annually adjusted monthly earnings, 35 highest years, and then they have what they call bend points. For a certain percentage, they're going to bend it, and they're going to credit you with a high percentage for the first bend, a lesser amount for the second one, and then there's a third one. But these bend points are calculated to come up with what is your primary insurance amount, a PIA. This is PIA is always going to be tossed around. That's your primary insurance amount. That's the estimated amount that you would receive at your full retirement age. So PIA is just an acronym you do want to familiarize yourself with. COLAs, or cost of living adjustments, we're pretty familiar with. But they do this calculation. Here's a quick look at a baby boomer who was born in 1960 and has turned 62 today. Well, what's significant? Who can tell me what's significant at age 62? That's the earliest age that you can collect, unless it's in a situation where you're a widow or a dependent and someone with a PIA that they're already receiving, then those benefits accrue to you. But on your own work record, the earliest that you can take that is age 62. So in this instance, this is a high earner. To help you understand the calculation, this is almost a maximum amount that somebody from age 60 can earn. Because what they're doing is they're cutting this off at the maximum taxed amount. This year, if you remember, was $147,000. So for all the years that the person has paid in, their average indexed monthly amount is going to be $11,430. So then they break that up and they have the endpoints. This is all a very complicated math formula. But as you can see, you're actually getting 90% of the low income, the first $1,000 coming back to you every month. So if you notice, that means that Social Security weights itself towards lower and lower middle income earners. The more money you're making, the less replacement there is when you retire. The next segment is you're taking the next $5,142 and you're getting a 32% credit on that. So then they're adding it together and then they take the remainder amount, and the highest earnings portion is only credited at 15% replacement. So that's an example of a high earner and where they'd be at regular retirement age if they were born in 1960. So that's good to know. Why shouldn't I just claim at 62, get all my money? Why would I think of doing this delaying stuff, or the idea of waiting till age 70? It's a great question. And this is a second insight we want you to be aware of. Your monthly benefit will be reduced if you claim early. It also will be reduced because in most instances, there's going to be some taxation of your Social Security benefits. You can see as much as 85% of your benefit being taxed. The other way that you'll see reduction is not only in income tax every year, but almost everyone who's age 65 and is taking Social Security uses the ease of paying their Medicare Part B premium. Medicare has got, it's on your work record again. You've earned hospitalization. Part A, if you've had a work record that goes for 40 quarters or 10 years of work. Part B, you also is doctor's services and doctors and other services beyond hospitalization, and that has a premium attached to it. So you may have stopped working and not seen money going into Social Security anymore or into Medicare, because Medicare also has its premium added on to that. There also could be a reduction in benefits if you continue to work and make in excess of roughly $20,000. At that point in time, it's kind of we'd like to discourage you from taking Social Security until you actually decide to retire. So what they'll do is they'll withhold some money. It doesn't disappear. They'll make an adjustment when you quit working and no longer have the taxable income, and you're just relying on Social Security and your other investments, and they'll recalculate it, and those funds that were taken back were not paid out to you because you were working and getting Social Security, get factored in so they get paid for the rest of your life when you do quit working. So when should I apply for benefits? Well, you've got a whole lot of choices, and it depends on, quite honestly, a lot of factors that you want to take into account. But what you want to look at, if you can do some planning now, is what's my health status? If I delay taking my Social Security, I'll get a bonus for that. But there is a break-even point. So unless your health is good enough so that you live into at least your mid-70s, then it might be worth your while taking the money now. If you think you're a good investor or you've got something specific for those dollars, there's a fairly long lag between age 62 and say age 77. I mean, that's a 15-year lag, and it could take that long before the additional dollars that you would get for delaying start to pay off for you. The flip side is, remember, every decision you make impacts your spouse and maybe your family. And if you delay longer, from a financial planning standpoint, we're almost always suggesting you consider that because it has an impact on your spouse. If something happens to you, the delay that you've made will in fact pay the spouse, if you're the higher earner, will pay the spouse more for the rest of her life as well. So that's what we look at. Those are all factors that you have to take a look at. Now, I can say that my late wife's matron of honor was divorced and got to age 62, and I explained to her, well, you can file on your divorced husband's account and you can wait and you'll get more money. And quite honestly, her response was, she survived breast cancer. Her mother was not in good health. She didn't think genetically she had a great profile for family health. And her best decision was, I'll take the reduced amount now. It's spendable money. Now she's still with us. If she had delayed, she had enough of a career so she had other dollars she could have spent, but she wasn't so sure of that. She was concerned about whether or not she was going to live long enough to make the sacrifice of waiting. And the only thing that would have benefited was for her kids if they were minors. And at the point we were having the discussion, they were all in their 20s. So as minors, they wouldn't see Social Security support if in fact something happened to her and she delayed. So that would just leave the money in the pool, which would go to other beneficiaries. So it's a personal decision, but these are all factors that make up a good decision. Now, will Social Security be enough to live on in retirement? As I see folks, the answer is probably not. Hopefully you're planning ahead and you're saving, and there'll be more than just Social Security for you to retire on. So full retirement age is, as we do these calculations, these discussions about maximizing things, are important. If you were born before 54, you're still at age, you've gone from age 65 to 66, and then if you were born after that, there's a gradual couple of months added on before your full retirement amount gets you the 100%. And everybody born in 1960 and later, the month that they turn 67 is the month that they have their full retirement age and get 100% of their projected benefit. So what happens if I apply for early benefits? Well, you will see a reduction. So someone that wants to take money immediately at age 62, if they were a age 66 full retirement age beneficiary, then they see a 25% reduction for as long as they live. So they're only getting 75% of what had been projected for them if they had waited until age 67. So the question is 5 years worth 25% of a monthly income for the rest of your life, however long that is? So if your full retirement age is 67 and you retired 65, I've had people tell me, well, Steve, I don't care about the 6.5%. I mean, that's close enough. I'll take 93% and be happy. And quite honestly, these days, you're going to receive what has been promised you there. And if you have done any delays, you do get credits for that. We don't have delays here, but we do have cost of living increases. So we've just seen cost of living, the COLAs being announced with the whole inflation story coming out of the White House of, well, it's only 8.5%. Well, that's a pretty big number, the biggest number in 40 years. But the good news is that'll also translate into much more than a 3% gain in your cost of living adjustment Social Security. So folks that retire next year will see the benefit of probably somewhere at least in the neighborhood of a 7% increase over what had been projected. What if you apply for early for benefits? I think everybody's looked at the fact that you are getting an 8% increase, but on the flip side, you're getting an 8% deduction for every year that you decide to apply early. And you just have to decide where on the chart would you like to be. If you have 100% at 67, but you want to retire at 64, or even you have to retire for a reason, that's your decision. You're entitled to the percentage that you've earned up to that point, and you can talk to the Social Security Administration. So this is the what if you apply after your full retirement age. So this just tells you if your age is 66, at age 70, you're getting 132% of what had been projected for you. And if your age was 67, you're still getting 24%. And now that's just for each year. Remember, both of those figures are boosted by whatever the COLA is going to be for those intervening years. You folks, I encourage you, first off, you should all go to set up your account at My Account. Obviously you've got that to take home. You've got a retirement estimator, which if you put in even know enough about your current situation, you can put that into the retirement estimator and come up with this year's estimate at full retirement age. And there are a bunch of other planning and benefit calculators at ssa.gov. They're free to use. They encourage you to play with them. So check your account, make sure it looks accurate, and the sooner you catch a flaw or a missed dollar or something. I mean, people sometimes key it in wrong. But it doesn't happen very often. That's the good news. And the other ones, you do have the estimators and the calculators make use of those. So why delay benefits? These are actually just using some real numbers. So the benefit, now this is using a 2% COLA, and quite honestly, I don't think we're going to see COLAs less than 4% for the next 3 years. But at only 2%, if you decided at age 62 and you claimed, you were going to see a COLA benefit, we started at $2,100, but even at that point in time, if you delayed from 62 to 70, you're seeing $4,359 in a check because of COLAs, or even just, the delaying credits are getting you from $2,100 to $3,700. That's a lot of spendable money, folks. Why delay benefits? Quite honestly, you're looking at the real math of if, in fact, you expect to live at least to your mid-70s, then if you don't benefit from the increase, your spouse will. So bigger checks to start. Once again, that was just we were working on the math there. And more income later. What this is just a look at if you claim at age 70, when your benefit age started at 70, you can just see that you're really getting up into age 85 even. You've gone from a $4,000 benefit to a $5,800, almost $5,900 benefit. And this is this is using 2%. So if we were using 4% or 7% COLAs, the money is even larger. And that's why in my business, as we talk to couples in that decision making, we are always going to suggest they delay unless they are uncomfortable based on health, family history, or something else that tells them that they may not live long enough to recoup the dollars that they gave up early on in terms of collecting those early dollars. So how do I maximize my benefits? Well, that's one other important thing that we want to discuss today. Remember, you've got a record where they're going to put in 35 years of your earnings. So you want to be looking at the record, make sure it's accurate, make sure they didn't miss any years, and can you improve it by working longer? And the answer is yes, you definitely can. So what you want to consider is, what are your income needs? Everybody should be looking at their budget. All right, if I quit a year from now, what are my expenses going to be? How's the mortgage change if it does at all? Have we paid off the house? Are we moving to a less expensive area? Are we selling and renting? Are we buying the RV and driving 10,000 miles a year all over the country? I mean, there are all kinds of choices, but you need to be putting down a roadmap of where you want to go and what you want to do and what those expected costs are going to be. And then you want to take a look at the optimal time for applying. So what are your income needs now? Can you spend the 401k for 5 years so that you go from age 66 to age 70? And then benefit from the 24% increase. If you can afford to do that, I'm always going to suggest that you do that unless we really have serious current health issues. Okay, so taxation of benefits. Unfortunately, yes, we do get taxed if we work and want to collect Social Security at the same time. So if you apply for Social Security before your full retirement age and you do work, they have a clever little thing that they say, well, gosh, we want to discourage that. So if in 2022, it'll probably be next year, 20,000 something, because it increases every year. But let's say, if you find a part-time job or a low-paying job that only pays you $19,000, then no problem. I mean, you're going to get your Social Security numbers, you're going to have your $19,000, you just go pay your taxes on it, and you're fine. If you earn $40,000, they are going to look at your Social Security check, and they're going to withhold $1 for every one of those dollars over $19,500 that you have on your W-2. Now, you don't lose it, you just don't see it for a while. It actually will get, when you quit working, they'll recalculate everything, look at those dollars that they withheld, and then they'll come back into your revised benefit when you do quit working. This only applies if you're working before your full retirement age, and you ask Social Security to start your benefit. Then they'll look at how much is the W-2 wage that you make in that year while you're getting your Social Security. And they'll apply this formula about how much is withheld and paid to you at a later date. It's complex, folks. But I just warn you for that. I mean, folks, if they're saying, all right, I want my Social Security right now, and I'm still working, and I can draw, so I'll take it now. Thank you very much. Well, if you're making more than $20,000, you're going to see a reduction in what you otherwise expected. You know, that's an important point. I mean, it only applies to you if you decide you want to take your benefit before you quit working and you're not at your full retirement age of 67. Okay, just for clarity. So taxation and benefits, once again, you know, we've paid taxes on this, but we may get taxed again because there's a process that said, gosh, we're trying to make sure that you're at a level where you're retired when you're getting Social Security income. So they will do a calculation that says, we're going to figure out by looking at your adjusted gross income, and your accountant or your tax, Tax Pro software will tell you what your AGI is. You then take a look at your benefit, your Social Security benefit, and you take 50% of what you were actually paid in that tax year. So if you didn't start until September, you're only looking at 4 months, not the whole annualized Social Security. And if you're invested in municipal bonds or tax-exempt interest, they don't want rich folks to get out of this taxation by putting everything in muni bonds. So they say, oh, all right, well, tell me about your tax-exempt interest. We're going to add that to half your Social Security, add that to your adjusted gross income. And if you're married, if that totals over $44,000, we're going to make you pay taxes on 85% of your Social Security for that tax year. If that adds up to 32 to 44,000, then you're going to see 50% of your Social Security, which you've already been taxed on, you're going to pay another 50% tax on it. So taxation is something we want to minimize. I mean, the more we minimize taxes, the more we've got to spend. So how do we do that? We want to take a look at other tax advantage investments, but not the municipal bonds. You can find tax advantaged investments and still, see ways to receive income, but not have it applied to taxing your Social Security benefit. RMDs are the government saying, we'll take a look at your lifetime and we'll start out and say you got to withdraw at least 4 or 5% of your $100,000 or whatever you got in the 401k. That comes in right at the top of your tax bracket, and so you're paying, the highest amount on it. The way that you get around that is everybody know what a Roth IRA is? It was named for Mr. Roth. It's such a good tax break that the IRS only lets you put $7,500 a year into it. You should be funding that. It's the only easy tax break that everybody can take advantage with unless you're a very high earner, in which case you can still put it in there after taxes without, Roth, everything goes in after taxes. You pay taxes on that $7,500, but you're paying taxes on the seed, and the whole dang harvest in the Roth IRA is tax-free. The other thing we suggest that you do as a financial planner is there's something that we refer to as filling up the bracket, and that is take a look each year when your accountant's doing your taxes, or if you're doing it online, and say, gosh, my bracket is up to $90,000 for at a 22%, for that those additional dollars. Now, if you're showing your taxable income is somewhere around $72,000, then the suggestion is do that conversion. If you've got dollars in the IRA, make it go all the way up to convert enough so that your taxes go up to $79,000, because you're already paying, that version, and we expect what? We expect taxes to go up. So do the conversion. Even at age 50, you can start converting into that Roth IRA. Once again, the other way that we want to minimize taxes is if we delay Social Security, we're reducing the number of years that those benefits could be subject to tax, right? So remember, when we're talking about, gee whiz, are we going to tax your Social Security benefit to the extent of 50% or 85%? Well, the more we delay that, the fewer taxable years you're going to have where your benefit may cost you more to the IRS. They talk about simpler lifestyle. That's always going to help. And just continue to work with an accountant or a professional planner so that you're managing the taxes through retirement. Medicare may shrink your check. So we're just talking about the fact that this year $170 is your Part B premium. Almost everybody that's taking Social Security for this simplicity has that taken out of your Social Security check. Well, you can see that if you had a PIA of $2,600 and you started at your full retirement age of 67, then this amount, if you were paying it this year, you'd actually be paying 9% of your PIA. If you delayed, once again, this is a little more of, we encourage the delay if you can afford to, because what's going to happen is if you wait until 70, you're going to get a bigger benefit, and your Part B is now only going to consume about 5% of your check. So when to apply for Social Security, so these are key points we want you to take away, and you've got them on your packet. If you apply early, the benefit's lower and it stays low for life. Everyone will get the COLAs whether they apply early or wait till late, but obviously they'll magnify the benefit if you wait. The longer you wait, the more it'll boost your benefit. Your benefit may be taxed, and it may be reduced by what you have to pay for your Medicare premiums. So don't let the earnings test discourage you from working. In fact, the best case scenario is if you love your job, you can't wait to get up every morning, and you work until you're 70, and then you transition, you still have your guaranteed issue at age 70 to start your Medicare program that you want to. In fact, your company may suggest you start Medicare at 65, and then they may pay the premium because you're saving them so much money being on Medicare instead of being in the group insurance, because boy, they get whacked for a 60-something-year-old in the group insurance world. So if you can keep working, or I've had some fantastic clients that hit age 65 or 67, I'm going to retire now, and I'm taking a job with a nonprofit that's going to pay me half of what they did, but I just love this group. And then they keep working and still have some benefits until age 70, and then decide, do I want to work beyond that? And I've got plenty of them, they're still working at 75 because they're working with kids or disabled or they're doing all kinds of wonderful things, and they love going to work every day because of the feedback that they get. But it's kind of like your second life. What can you give back now that you've finished a career of productivity? And you might be more productive given the experience that you have and bring to the organization. So any questions on that? Delaying benefits may, in almost every instance, give a surviving spouse a better life after you're gone. I mean, the only other thing you can do to help them out is make sure they're well insured. So I'm not going to live long. Why shouldn't I just claim now? It's back to the thing we just talked about for couples. Our insight and our suggestion to you is, if you can, you should always maximize a higher earner's benefit to protect who's left behind. So spousal benefits, the good news is, once again, regardless of what your PIA is, when your husband files, in this instance, John's PIA is $2,000, Jane's is only $800. She kept a house and got the kids out of school, into college, and off on their own, and so she didn't have a huge work experience. So at full retirement age, her benefit, instead of being $800, will be a spousal benefit of $1,000. So she gets a $200 raise because a spousal benefit is half the primary worker's PIA. And I've seen instances where that's a huge difference. I mean, mom was getting $325 and dad was a really successful executive. His PIA was $3,200. So she goes from $3-something to $1,600. Well, that's the way the spousal benefit works, and it's a great benefit. It works well, especially if there's a large disparity. Quite often these days, with both parents working, sometimes they're really close to each other, and in that case, it's still, well, pick one. Let's maximize and delay on the higher earner unless there's a health issue. Then you pick the other spouse and delay on them and still collect, because it's only going to benefit one or the other going forward. Rules are primary worker, must have filed. The spouse does have to be age 65 to have that step up for the reduced benefit, or she can have her whole full benefit at full retirement age. And once you do have the spousal benefit, then you can't have any more delayed credits on that account. So you do want to coordinate spousal benefits. The maximization strategy is, once again, the lower earning spouse's PIA, if there's more than a 50% difference, then we're actually going to suggest that you try and have both spouses delay, and one spouse takes advantage of spousal benefits if that's allowed. Now that has to do with a special situation where if anybody has a spouse or has been born before 1954 and haven't claimed yet, you were grandfathered. You have a special deal which was so good that Congress changed it and wiped it out a couple of years ago. And that is, if you're born in 1954 or before, you can claim on your spouse's record. They can what they call file and suspend. So they'll say, oh, I'll file for my benefit, but suspend it. I don't want any of it. Meanwhile, the spouse files on his account and receives the spousal benefit while he lets his account compound all the way to age 70. It was a great deal when it was available. It was too good a deal. That's why part of the reason there's $56 billion deficit. So Congress eliminated that if you were born in 1955 or since. So all that, if you don't fall in that category, the other strategy is called the hybrid strategy. So we take a lower earning spouse's primary insurance amount, and the lower earning spouse claims early, and the higher earning spouse, once again, delays to 70. So it generates some income, reduced income, but it's spendable dollars coming in, and it's going to make the higher earning spouse's benefit more valuable, having him delay until age 70. So we do this kind of stuff. I think I suggested, because of the sponsorship at Texel, that we'll be happy to do a customized planning analysis for spousal benefits. All I'd ask you to do is think of your 3 best friends who are at least age 60 and a contact thing, and we'll be happy to run that for you, and you can just see exactly what would maximize a couple's benefit. So that's the offer of the day. Widows and so on, and divorces, let's get into that quickly. I'm already widowed or divorced, so how does that impact my strategy? This is our last insight of the day. If you're widowed or divorced, you may be eligible for survivor benefits, divorce survivor benefits, or divorce spouse benefits that can only increase your monthly check. So the good news is it'll depend on what age the deceased spouse claimed. If they did, they may not have before they died. If they claim before their full retirement age, then that benefit will be limited to the higher of the spouse's benefit that he would have, or 82% of his PIA. And if he did claim after full retirement age, the survivor benefit will actually include all of his delayed credits. Now, the deal is, ladies, you'll have to have put up with him for 10 years. But if you've had a marriage for 10 years and then got divorced and you have not remarried, regardless of whether he is filed or not, you can file on his work record after any 10-year marriage. So and the other news is, if you marry somebody, you're not eligible for his record. But if you divorce that new guy that didn't last 10 years, you're back to being eligible for the original divorced spouse. Survivor benefits, here's the example. Joe and Julie were married. They're both over full retirement age. His benefit was $2,800, hers was $1,500. If Joe dies, she just lets Social Security know, and she loses her $1,500, but the good news is she gets his $2,800. So she's actually going to be alone, but in that case, she's well above the 2/3 of a household to support herself, and hopefully not have to change her lifestyle. Example of delayed claim, they're both married. Once again, he's got the $2,800. He delays claiming to age 70, where he gets the higher benefit. When he dies at that point, she, as a survivor, will actually see all of his delayed credits. But once again, if she claims her survivor benefit before she reaches full retirement, remember both of them were at full retirement, then we worry about that. All right, so a couple of rules. You have to be married 9 months at the date of death, or else, unfortunately, it won't work. Survivor does have to be age 60 unless they're disabled, which they can be any age over 50. The survivor benefit is not available if they remarry before age 60, unless that marriage ends, at which point they're eligible again. And the divorced spouse benefit is only available if the marriage was 10 years. You need to know where the husband is so the Social Security can find him, find his work record, and then you have to have your marriage and your divorce papers. Oh, well, so this is the best example is Johnny Carson. He had 3 ex-wives that were all filing on his account, and it had no impact on his current wife. So it has no impact on the current wife or the other ex-wives. If you were married for 10 years, it's a benefit that you can apply for. And remarriage, does have an impact there. So this is more complicated. Well, let's go back to the brain teaser. So the question is, in life, would you rather be early or delayed? And do you want to pay a penalty or get a bonus? So if you haven't heard of behavioral finance, they've done a lot of surveys of Americans and investors, and they've come up with the idea that people would rather obviously have a bonus than a penalty. And they'd also rather not lose money than have a huge gain. So it's kind of like, well, it's satisfying to have a gain, but they're really dissatisfied if we have a loss. So what we're trying to do is we're trying to say, gosh, instead of having the problem of not making good decisions, we want you to remember these key insights. Social Security is the very best and very valuable inflation-protected income that you can't outlive, and it will also protect both your spouse and often kids as survivors. Your monthly benefit will be reduced if you decide to claim early, but it's your money, your decision. Just try and plan ahead so you make the very best decision to maximize things. Couples should always maximize the higher earner's benefit for the surviving spouse in her future life or his future life. And if you're widowed or divorced, you may be eligible for benefits that you might not have known about. But thanks again, and I'll be around for as long as anybody has a couple of questions. And I appreciate your being here. And TechSell, thank you for hosting. It's wonderful to give back to community education.